Welcome back to the Dynamis podcast. I'm your host, Tim Garul, and today we're diving into the key differences between four major loan programs: VA, conventional, FHA, and USDA loans. Now, there is a fifth category, and I'm not going to spend a lot of time highlighting or touching on that category today. We can circle back to that in a future episode, but today we're going to stick to the four main categories. Just as a brief overview of what that fifth category is, we call them non-QM or non-qualified mortgages, non-conventional mortgages. They fit into a box of this plethora of products for people who, are great borrowers, but have unique circumstances that we can't exactly fit them into the regular standard box of the traditional banking guidelines. These are people like business owners who make a lot of really great income, but can't typically show it because they write a lot of it off on their tax returns. These are products like bank statement loans, DSCR loans or debt service coverage ratio investor loans. These are bridge loans, construction products. There's a whole plethora of these types of products, and there's a reason to use them. There's a time and place to use them, and there's a specific avatar that these are associated with. But by and large, and for the most part, today, we're going to stick to the four main categories: VA, conventional, FHA, and USDA loans. We're going to cover some important concepts like debt to income ratios or DTI, seller contributions, credit score requirements, down payments, and something that impacts many homebuyers: mortgage insurance. We're going to explain what mortgage insurance is, which loans require it, and how you can remove it and why it's necessary. By the end of this episode, you'll have a detailed understanding of which loan program might be the best fit for your situation and when to use them. I can't tell you how many people, how many times I get a phone call from individuals telling me these preconceived notions, most of it from a rumor mill or maybe wrong social media advice, telling them about what types of loan programs they're eligible to use, who can use them, how they can use them. And quite often, most of the time, it's just simply not true. I can't tell you how many people have disqualified themselves from a particular loan product just because they didn't do sufficient research or talk to somebody who's actually in the know, and they would years debilitating themselves, not giving themselves the opportunity to successfully get into one of these programs just because they had wrong information. So the goal of today's show is to kind of course correct, set the record straight, and then leave you with this episode feeling empowered to know which loan product, at least, which type of loan product you're going to navigate for, how to use it, and which one fits your solution the best. So with that, let's jump in. If you're a first-time listener, if you're joining us for the first time, this podcast, the Dynamis podcast, is here to give you the strategies and mindset to escape the rat race and earn financial and philosophical freedom, the freedom to fight for your beliefs. Join me as I interview hundreds of millionaires to deconstruct success and understand their secrets. I draw on real-life experience as a real estate investor, a former special operations soldier, and a firefighter. I'm here to build passive income. That's that mailbox money, guys. Passive income is that money that comes month after month, whether you're sick, whether you go to work, whether you're sleeping. It's that consistent base level of income, okay? And this show highlights the losses, the wins, and the many lessons learned along the journey. The goal of this show is to make you autonomous and financially free. As David Geffen says, we are each the figment of our own imagination, and some people have a greater ability to imagine than others. So if you want to remove your limiting beliefs, unlock a fruitful life, and truly become free, let's get to the next level together. All right. So before we dive into specific loan programs, let's define a few terms that you're going to hear throughout this whole episode, okay? Now, debt to income ratio, that's the first one we're going to start with. Also, you're going to hear me referring that to debt to income ratio as DTI. Your debt to income ratio is the percentage of your gross monthly income that goes towards paying the debts, okay? And there's two types of DTI. There's front-end DTI, and that's the percentage of your income that goes towards housing costs like your mortgage, taxes, and insurance. And then there's back-end DTI. This takes all your monthly debt obligations into account, and it includes things like credit cards, car loans, student loans, as well as your housing costs, all right? DTI helps lenders assess your ability to manage monthly payments and determine how much you can afford. So for example, if you could qualify for a home with, let's say, a 50% debt to income ratio, and you made $10,000 gross a month, that means that your total debt obligations could be $5,000 a month and you're still able to qualify for a home. So that is what DTI is. It's how we calculate it and it's why it's significant. All right, the next thing we're going to cover is called seller contributions. And these are the costs that a seller agrees to pay to help with your closing cost expenses, things like loan origination fees, appraisals, or even buying down your interest rate. Different loan programs have limits on how much a seller can contribute, and we're going to get into that as we get into each subsequent loan program. And the next concept that we're going to cover, and this is like a really key one because some programs make you have this and some don't, some allow you to drop it off and some don't, and it absolutely impacts the affordability of your monthly payment, is this thing called mortgage insurance. And what mortgage insurance is it protects the lender in case the borrower defaults on the loan. It's typically required when you put less than 20% down on a home, okay? It allows the lender to offer loans with lower down payments while managing the risk. I get a lot of people are like, man, mortgage insurance sucks. Yeah, it absolutely does suck. But when you think about this, the bank is giving you the majority of the cash required to buy a house. So in the instance of a first-time buyer with conventional 3% down, or FHA with 3.5% down, the bank's giving you 97% of the funds required to buy an asset. And in order to mitigate the risk, that's very risky for them. In order to mitigate the risk, they require you to carry an insurance policy that protects them when you have less than 20% equity. And how this works is if you were to default, okay, the bank is very leveraged on this property. So they give you most of the money. If you default and the house goes into foreclosure, what typically ends up happening is the property eventually gets auctioned off. And when it goes to auction, it's purchased by a new consumer for pennies on the dollar at the auction steps. So if the bank purchased the house for, 97% of its value and it gets auctioned for 60 cents on the dollar, they're in big trouble. So in order to hedge their bet, what they do is require you to pay an insurance policy called mortgage insurance that protects them on that 20% equity. Now, that mortgage insurance, depending on the loan program, can go away, and some is more expensive than others, and we're going to talk about that down below, but that's what mortgage insurance is, and that's why the bank requires you to carry it. So the terms and conditions vary by loan type. We're going to cover this in detail below as we go through each loan program. But what I wanted to do is go through each loan program, tell you about the kind of left and right limits of them, and the pros and cons. And the first loan product that I want to start with is my personal favorite, and that's the VA loan. Now, this is my personal favorite because it's how I got started buying real estate. This was really a huge benefit. It's like this knockout powerhouse punch. And I think a lot of people in today's market don't really understand the absolute insane punch that this VA loan packs. It's a loan that's guaranteed by the government, and there's so many pros to this loan. So let's just get into it. We'll start top to bottom, go through pros, cons, and the kind of left and right limits here. So who can use a VA loan? So any eligible service member, active duty service member, or eligible veteran is able to use a VA loan. Now, there are some exceptions to that. For example, if you are a spouse who has an entitlement of the VA loan, let's say that you're a Gold Star spouse, meaning your spouse passed away in active duty or in time of combat, some of those veterans benefits do transfer to spouses or children. So there are instances where you don't have to actually be the veteran to use this type of a product. All right. So service members and veterans can absolutely use this product. If you are in active duty, you can absolutely use this product. In fact, looking backwards as a veteran, one of the biggest disservices I ever did to myself was not educating myself about the VA loan benefits and not using them while I was on active duty. I look back and I thought to myself, if I would have bought a 2-unit or a 3-unit, rented out to my buddies in the military and house hacked it, by the time I got out of the military, I'd have a cash flowing asset and I could have just kept that ball rolling. I can't tell you how many veterans are under the impression that they're not allowed to use the VA loan until they actually end their time in service and become a veteran. That is simply not true. All right. So let's talk about the DTI, or debt to income requirements for VA loans. VA loans typically recommend a 41% DTI. Okay. But they use something a little unique called a residual income to offer more flexibility. So what residual income is the money left over after paying your mortgage and living expenses like taxes and utility. So if your residual income is strong, then lenders can approve much higher back-end DTIs. All right. Sometimes, I've got one in escrow right now that's going to close that we have this veteran at a back end of a 68. But because their residual income is so high, they qualify for the loan. Technically, the VA doesn't actually have a DTI requirement. It's more based on that residual income. All right. So this is case by case. You apply. We look at your overall income. We look at your residual income left over, and we make a determination of whether or not you can qualify. Now, credit score requirements for VA loans. The VA doesn't exactly set a strict credit score requirement, but most lenders, I'll just tell you right now, are going to require a minimum score of at least a 620. Now, here's one of the magic things, the secret sauce about this VA loan. VA loans don't require a down payment, which is an absolute huge benefits. Eligible veterans and service members can finance 100% of the home's purchase price. And on top of that, can receive up to a 4% seller contribution. Remember, we talked about seller contributions in the beginning of the episode. That's a contribution from the seller to cover certain expenses of the mortgage or of the loan. So sellers can contribute up to 4% of the loan amount to help cover closing costs, prepaid expenses, or even pay off the buyer's debts. So here's something that's actually pretty unique. That 4% rule can actually be expanded upon, because if it's considered a standard closing cost, that 4% rule isn't counted against that. So you can have a seller, you can put zero money down on this loan as a veteran, have a seller cover all of your standard closing costs, and still give you up to a 4% contribution of the loan amount to cover additional costs or expenses, things like an interest rate buy down. And what really makes this one really impactful is the veteran can also use seller contribution to pay off debts in order to qualify for the loan. Things like credit card debts or car payments. I've had a veteran, we've been in escrow, who asked for a seller contribution, got all of their closing costs covered. So they put no money down, got all their closing costs covered, and the seller gave them a check to go pay off their car so they could qualify for the loan. This is an absolute mind-numbingly powerful product for veterans. All right. So mortgage insurance, we talked about that mortgage insurance policy up above. And typically, there's ways to calculate how much mortgage insurance is, but it's typically a couple $100 a month. Here's the next magic sprinkle on these VA loans. VA loans don't require mortgage insurance. However, they do require a funding fee. And what this funding fee is it helps sustain the VA loan program. And that fee varies based upon your down payment and whether you've used the VA loan before. So if it's your first time using this VA loan benefit, the funding fee is slightly less expensive. If it's your second or subsequent after that, it's a little bit more expensive. But the benefit of that funding fee is that it can be rolled into the loan amount, so it's not an upfront cost. Now, if you are a disabled veteran, meaning you have a VA letter stating that you have a service-connected disability, here's the magic sauce again, you can completely have that funding fee waived or eliminated. All right. So why mortgage? So we're talking about mortgage insurance. So why this matters is that no mortgage insurance means you're going to have a lower monthly payment, making VA loans one of the most cost-effective loan options. So key takeaways for VA. VA loans offer no down payment, no mortgage insurance, and flexibility with DTI due to the residual income rule. It's one of the best loan options for veterans and service members. So you can use your benefit, put no money down, get your closing costs covered, get debt paid off. You could have potentially no VA funding fee, no mortgage insurance, and really, really loose debt to income requirements. The VA loan, guys, I'm telling you, it is such an incredible product and such an incredible benefit for our veterans. So that's VA. Now I want to cover category number 2, and this is more standard. This is what most people, the box that most people fit into. This is the conventional loan. All right. This is popular for both primary homes and investment properties. One thing I did want to touch on the VA loan. This is for, primary residence only. So you cannot use a VA loan for investment properties, second homes, things like that. The VA loan is for primary residences. The VA really wants the veteran to occupy and live in that house. Now, what you can do, all right, what you can do is vacate that home at some point in the future, leave your VA loan in place and go purchase subsequent homes. You don't have to, you're not like, stuck with a refinance. And in some cases, you can even use your VA loan again, depending on how much entitlement of that VA loan you have left over. And there's calculations that we do to figure out whether or not you can use your entitlement again, how much you have, so on and so forth. But you're not forced to refinance. Just because you have one VA loan doesn't mean you can't buy any more properties. It just means we have to look at how we're going to buy those properties. And even if you don't have a full entitlement to purchase another home with a VA loan, typically your down payment is reduced because a portion of the down payment is still covered by whatever remaining entitlement you have left over from the VA. So back to conventional. All right, let's talk about debt to income limits for conventional loans. So the conventional debt to income ratio, the standard maximum DTI for conventional loans historically was about 43%. But what we're seeing right now is we're at about 50%, depending on if you have strong credit and assets. So if you have good credit, we can get you up to about a 49.5, almost 50% debt to income ratio. Credit score requirements for conventionals, these are typically minimum credit scores of 620, but something to note is that, and this is with any loan product, borrowers with a better credit score get better interest rates. So if you have a score of 700 or higher, you're going to get the best rates. And we love to see 750 plus. I mean, you get the best interest rate that are offered out there. And the reason that is significant is, the better the credit score means the lower the interest rate you get. The lower the interest rate you get, the lower the monthly payment, making your overall cost of this mortgage much less. So let's talk about down payment requirements. You can qualify for a conventional loan with as little as 3% down if you're a first-time home buyer, or up to 5% down for other borrowers. Now, you can put more money down. So if you want to put 10% down or 15 or 20 to not pay mortgage insurance, you can absolutely do that. But the minimum requirements is somewhere between 3 and 5%. Like I said, to avoid mortgage insurance, you're going to need to put at least 20% down. Now, seller contributions on this one are a little bit different. All right. So seller contributions depend on down payment. So the seller on a conventional loan can contribute up to 3% if your down payment is less than 10%. Now, if your down payment jumps up between 10 and 15% of a down payment, the seller can contribute up to 6% in a seller contribution. And if you put down more than 25%, the seller is then allowed to contribute up to 9% in seller contributions. Here's something that is pretty unique to conventional mortgages in comparison to some of these other government programs, and that is the mortgage insurance aspect of it. If you put less than 20% down, you're going to be required to pay private mortgage insurance, or PMI. But you do have the option to have it removed. So the good news is that PMI is temporary. And once you reach 20% equity in your home through payments or appreciation, you can request to have the PMI removed. So lenders are required to automatically remove it when your loan balance reaches 78% of the original value of the home. And so what equity is, if you're listening, you're not quite sure, when that mortgage insurance could be removed and your payment can drop down. How this works is, let's just say that you have a house that's worth, $100,000 and you have a loan amount of $90,000. Okay. So you have 10% equity in your home is how that works. If it appreciates over time. So every year it's worth more and more. Every year you pay your mortgage, the mortgage payment the loan amount is going down and down and down. When that ratio gets to 20% or more, it exceeds 20% or more, then you have the ability or option to remove that mortgage insurance. Now, depending on the bank that holds your mortgage, sometimes they require you to keep mortgage insurance for at least 2 years. You have to read the fine print of that. But the benefit is that you can remove that. When you remove that, your payment is going to drop by that mortgage insurance amount, which can be a couple $100 a month, depending. So, yeah, so it can be removed once you build up enough equity, making conventional loans a super solid option for long-term affordability. So the key takeaway with these conventionals is that conventional loans require PMI with less than 20% down, but you can remove it once you reach 20% equity, making a temporary expense. And the down payment requirement is between 3 and 5%. Now, I will say, if we're going to rate who's got the best interest rates, typically VA and FHA have the lowest interest rates out there. USDA has really competitive rates, and then conventional products are more expensive, just a little bit more, right? So a conventional loan, a 30-year fixed interest rate is going to be a little higher than an FHA loan. Now, if you're buying an investment property or a second property, interest rates are going to degrade from there. So primary residence, the government really likes to incentivize homeownership. So they're going to give you a better interest rate. As you buy investment properties, the interest rates are going to be less and less competitive. So conventional has a little bit higher interest rate than like an FHA, but it kind of balances out. And I'm going to explain why down below when we get into FHAs. And actually, that's a good segue to jump into the next product, category number 3, which is the FHA loan. All right. So FHA loans are a great option for buyers that have lower credit scores or limited cash for down payment. Okay. So let's talk about DTI again, debt to income ratio. FHA loans allow a front end DTI of a 31% and a back end of 43%. Remember, that's like the really strict rule. However, the DTI on these FHAs are actually closer to 55% for the back end DTI if there's certain compensating factors like credit or reserves in place. Okay. FHA loans require a minimum credit score of at least 580. So the reason that this is really beneficial is if you have some credit issues, maybe less liquidity or less reserves, you're really just starting out in life. This FHA product is really beneficial for you because it allows you to get into a mortgage with a lower credit score. All right. And the down payment requirement is 3.5% down, 3.5% down. So for those with a credit score lower than that, we can make it happen. It gets a little more difficult, but let's just say, for instance, you have a score between 500 and 579 for a credit score. We're going to need to start getting creative with down payment, maybe coming up with some more money down, maybe up to 10% in certain circumstances. So FHA loans require 3.5% down for credit scores of 580 or higher, and 10% for scores of 500 to 579. Seller contributions on this one. And this is a awesome benefit. FHA allows sellers to contribute up to 6% of the purchase price towards closing costs. Now, here's where FHA gets a little sticky. Now, FHA interest rates, I told you, are really great. So if you were to price FHA versus a conventional, let's just say in today's market, okay? So today is, September 11th, 2024. Maybe a year from now, interest rates will be back in the 3s and you'll be listening to this podcast thinking like, dude, this is old information, but I'm just using this as a apples to apples side-by-side comparison. So if we took fixed 30-year interest rates with 750 credit scores or above, an FHA right now would price, let's just hypothetically say 6.3%, okay? And conventional is like closer to 7.25%. So there's a substantial difference, almost a full percent higher from FHA to conventional. But here is what is interesting is that FHA, the total monthly payment between conventional and FHA almost come out to be the exact same. And I know a lot of people get hung up on lower interest rate, but when you look at the payment ends up being almost exactly the same. And the reason is that because FHAs have more expensive mortgage insurance. So FHA loans require mortgage insurance premiums, which comes in 2 forms. There's the upfront mortgage insurance, which is typically 1.75% of the loan amount, which can be rolled into the loan amount, so it can be financed. And then there's also annual MIP, and that's paid every single month as part of your mortgage payment. This is your mortgage insurance portion, all right? The catch with FHA, though, is that the MI, the mortgage insurance, stays with the loan for the life of the loan. And it is typically more expensive than the mortgage insurance on a conventional loan. And that's how the payments end up equaling out. They become really, really close. So why this matters is, unlike PMI on conventional loans, FHA mortgage insurance can be more expensive in the long term, since it typically can't be removed unless you refinance into a conventional loan. And here's my suggestion on this one. Is that if you have to get into an FHA loan, which these are great products, guys, there's nothing wrong with FHA loans at all. But if you're worried about, your hesitancy is like, man, I don't want to pay mortgage insurance long term, Well, then my suggestion to you is like, who cares? Because when the market changes in a couple of years, you're making more money in a couple of years, you're more stable, your home's appreciated, you're paying down your mortgage. When you would be qualified to drop that mortgage insurance on a conventional loan anyways, we can just refinance you out of the FHA loan into the conventional loan, probably drop your monthly payment, and also knock off that mortgage insurance. So it's really not, it shouldn't be a huge barrier to entry if you, for some reason, are opposed to FHA. I have a ton of buyers right now that are getting into the market using the FHA program, and we're refining them in the future out of the FHA into conventional, knocking off that mortgage insurance. So this shouldn't be a barrier to entry for you. It should be like, okay, this is a really strategic move on the chessboard as I continue to put more pieces on the board and make bigger and bigger moves. So key takeaways for the FHA is that FHA loans have flexible credit requirements and low down payments, but the mortgage insurance lasts for the life of the loan with less than, it just lasts for the life of the loan, making it more expensive over time. Okay, so we're going to cover the fourth category now, and this is definitely a category that is much less used. It's not as common. It's a government loan, and this is called a USDA loan. All right. So this is for buyers in rural and some urban areas, and I'll explain. So historically we think of USDA loans out in the middle of nowhere. But you'd be surprised, there are actually some urban areas that allow certain homes to qualify as a USDA purchase. So USDA loans, the downside of the USDA loan is that the debt to income ratio limits are much more strict and they're lower. So USDA loans allow up to between a 44 and a 46% debt to income ratio, depending on if you have, strong compensating factors like high credit reserve, so on and so forth. Most lenders are going to require a credit score of 640, though some may approve scores as low as 620. It really depends on risk ratio here, guys, the borrower that is applying. So here's the really awesome benefit of the USDA, though, and it's similar to the VA loan, is that USDA loans don't require a down payment, making them super ideal for buyers who may not have a lot of savings. The seller contributions on these USDA loans, sellers can contribute up to 6% of the purchase price towards the closing costs, prepaid expenses, or other concessions. All right. And then for the mortgage insurance portion, USDA loans don't have traditional mortgage insurance, but they do have guarantee fees, which are similar. So there's an upfront guarantee fee. This is 1% of the loan amount. It can be financed into the loan. And then there's an annual guarantee fee, and this is 0.35% of the remaining loan balance paid every single month. So why this matters? USDA guarantee fees are typically lower than FHA mortgage insurance, making USDA loans a little bit more affordable over time, especially with no down payment required. So the key takeaway here is USDA loans don't require down payment. They have lower mortgage insurance like fees. It's not exactly mortgage insurance, but it's similar. But they are limited to buyers purchasing homes in eligible rural, suburban areas. And how we do that is there's a website, and we go to it and we look at the property and we see if it's even allowed or eligible to qualify for USDA financing. So if you have a question about USDA loans, you're going to need to reach out to a person just like me, and I can just do a quick search and tell you if it qualifies, if it's eligible or not. So really quickly, I want to recap these four categories one more time. Let's do a quick recap and comparison of the debt to income limits, credit scores, down payments, mortgage insurance, and seller contributions for each loan type. So starting from the top, VA, DTI limit of there is none. There's no DTI limit, but it's based on a strong residual income. Credit score of 620 or higher is typically required. No down payment. A max seller contribution of 4%, up to 4%, but that's on top of getting your closing costs covered as well. There's no mortgage insurance, and borrowers pay a one-time funding fee, which can be waived if you have a VA disability. Conventional loans, debt to income limit of about 50, depending on if you have good credit and assets. Credit score requirements, minimum of 620, but you're going to get better interest rates above 700 and 750. Down payment requirements are between 3 and 5%, and the seller contributions are 3% if you have a down payment less than 10%, 6% for a down payment less is 10 to 25%, and 9% seller contribution if the down payment is over 25%. So mortgage insurance is required with less than 20% down, but it can be removed once you reach 20% equity. All right, and now we're going to move on to FHAs. DTI limit up to 55, we'll say back end, with compensating factors like good credit and assets. Credit score minimums, 580 or above for a 3.5% down. And then there are workarounds. It gets more difficult, but there are workarounds if you have a credit score between 500 and 579 with increased down payments, let's say up to 10% down. So down payment requirements are 3.5% down. Seller contributions on these FHAs up to 6%. And mortgage insurance is required for the life of the loan. And don't forget that you have that upfront mortgage insurance fee. So USDA loans, DTI, debt to income limit up to 46, a minimum credit score of 640. Some lenders will accept a 620. We just have to look and see. Down payment requirement is none. You don't have to put any money down. You can have up to a 6% seller contribution. And the mortgage insurance, there are required guarantee fees, which are similar to mortgage insurance, but not quite the same thing. But they're generally lower than FHA insurance. So each loan program that we talked about above, it serves a different type of buyer, right? So VA loans are highly flexible with no mortgage insurance. Conventional loans, they allow for PMI removal. FHA loans offer accessibility, but with long-term mortgage insurance. And USDA loans, they offer no down payment with lower guarantee fees. So all of these products are powerful in their own right. And it really takes someone who's a strategic expert to come along to look at your scenario and tell you what product best suits your needs and when to use them, how to use them. Just do yourself a favor and stop listening to social media advice. Oftentimes it's wrong. Just call somebody, call an expert, call a person like me and go through these programs. We're happy to talk through them and figure out what the best option is for you to get you where you want to go most effectively and most affordably. So yeah, that wraps up today's episode, guys. I hope the breakdown of DTI limits, credit scores, down payments, mortgage insurance, and seller contributions for VA, conventional, FHA, and USDA loans gave you a clearer understanding of your home loan options. As always, if you have any questions or want some personal advice, don't hesitate to reach out to me. I'd love to help you navigate your mortgage option and find the best fit for your needs. This is a true passion of mine. This is what I do every day, all day. But with that being said, thank you for tuning into the Dynamis podcast. If you're a first time to the show, go ahead and give us that little like and subscribe hit. And we put out a lot of content just like this that's really beneficial to you guys to help you on your journey to reaching financial freedom using this wonderful asset class of real estate. So until next time, stay focused on your financial freedom, and we will catch you on the flip side.